Ray Dalio is gifted with a vision for the market, and this has led him and his Bridgewater fund to great success. He has a knack for entering and exiting stocks at the perfect time, and for that reason, our ears perked up when hearing of Bridgewater selling off massive amounts of 5 different Chinese stocks. In this video, we'll examine what 5 stocks he let go of and his reasoning behind it. Stick around until the end though, because he did have his fund pick up one particular Chinese stock that could be very lucrative in the future. We'll analyze this exciting stock to see if the train has left the station or not. So without further ado, let's get started. Mr. Dalio is not only a thought leader in the space of finance, he's actually one of the biggest players. Ray has held the position of co-chief investment officer at the world's largest hedge fund, Bridgewater Associates, since 1985. He has brought to light many important philosophies and business practices related to investment and corporate policy. Ever since he helped found Bridgewater, the firm has gone on to gain numerous big-name clients such as McDonald's, Eastman Kodak, and the World Bank. The fund was managing over $140 billion of assets for investors as of last year. His expertise in wealth management and the understanding of finance that he's gained through such massive partnerships have made him a go-to voice for many people seeking sound investment principles. But first off, we need to understand the context of the Chinese stock market. Volatility has been at a high the past year or so as government officials methodically crack down on multiple companies and put new regulations in place. The government is doing this so as to protect Chinese intellectual property and technology, as well as to maintain control over their market. These new regulations have targeted monopolies and false advertising, as well as other unsavory behavior by the boards of these companies. Unfortunately, regulators are not overly concerned with the well-being of the stock prices of these businesses. For example, Tencent is now barred from entering any and all exclusive music copyright agreements. Naturally, the company stock then took a major hit after this announcement. Many investors have either exited Chinese stocks or been too hesitant to enter in the first place as we continue to watch this play out. While the regulatory pressure has been lessening, it doesn't mean that things aren't still questionable within the stock market overseas. In fact, the Chinese ride-sharing giant Didi Global was recently delisted from the New York Stock Exchange entirely, all due to heavy regulations being implemented back in its country of operation. And now this brings us to the main subject of this video, Bridgewater's major Chinese stock sell-off. Didi Global was one of the first to go, as its stock began trading only over the counter, and it was then a no-brainer for Ray Dalio and his team to drop this one, but it's worth noting regardless. The same regulatory pressure that forced Didi off the market could do the same to any other stock at any time. Bridgewater offloaded 8.2 million shares of Didi, apparently having given up on making any more profit from the failing Uber-style company. Another very significant sale was Dalio's cleaning house on Bridgewater's Alibaba shares. Alibaba is an e-commerce giant in many Eastern countries, but has run into its fair share of legal and regulatory issues. Investors everywhere were taken by surprise when Alibaba's CEO Jack Ma, one of the richest men in China, went missing for 3 months after criticizing the government's incompetence within the financial system. Things like that tend to tank a stock, but before the government put its crosshairs on Jack Ma and his company, Alibaba was trading at over $300 per share. It's been in free fall since and now rests at roughly $80 per share. Ray Dalio and Bridgewater Associates ditched 7.48 million shares of the stock in order to avoid further losses. Yet another million shares of stock were sold as well, belonging to Bilibili Inc., a popular video sharing website from Shanghai, and it's the leading anime, comics, and gaming community in Southeast Asia. But the company has been reporting poor earnings and an equally abysmal future forecast, not to mention the regulations hitting entertainment companies across the nation. And this particular sale may have something to do with how entertainment monopolies are being handled, such as the Tencent situation we mentioned earlier. Restrictions placed on entertainment companies can severely hurt the bottom line, risking investors' money. Of course, that's not all though. JD.com is a large Bridgewater Associates holding, or should I say was. the fund sold off all 2.1 million shares of the Beijing-based e-commerce company. A new regulation from the US government may have actually played a part in forcing Dalio's hand, though. In 2020, Congress passed the Holding Foreign Companies Accountable Act. This means that if a foreign-listed company didn't submit to a formal audit for 3 straight years, it could be delisted. The Chinese government has historically been against US audits of their companies, despite being listed on the New York Stock Exchange. Now, China is loosening up and allowing it to happen in fear of having these companies delisted. Regardless, all of this talk of new regulations and audits has scared away many investors and funds such as Bridgewater. And the last of the 5 companies that were sold off in Ray Dalio's fire sale was NetEase Incorporated, an internet tech company providing online services centered on content, community, communications, and commerce. Bridgewater Associates sold all 370,125 shares of NetEase due to, you guessed it, regulatory pressure the company was facing. That's not even to mention economic troubles up ahead. NetEase is also one of the companies named by the US government as one of the first US-listed Chinese stocks up for audit. This certainly was a red flag for Dalio and his team, and it's no wonder that they sold their entire position. The future of all 5 of these stocks is unpredictable and rife with risk. Between Chinese crackdowns, US audits, and troubling economic signals, it's no wonder that Ray and Bridgewater decided to get rid of their holdings in these 5 major Chinese stocks. This isn't to say they won't ever be worth buying again, but I can understand why it may not seem worth the risk at the moment. But the interesting thing about all of this is that Ray Dalio and Bridgewater Associates actually increased their holdings of one select Chinese stock. This is surprising given the state of the market at the moment and ever-increasing government involvement. However, before we dive into this lucrative stock, I want to shout out Mr. Dalio. He's given us plenty of killer knowledge over the past couple of years during these confusing economic times. So if you would like to hear his opinions and advice on current financial matters, let me recommend our video, Ray Dalio's Final Warning: Inflation Will Change the World Order and Cause a Massive Market Crash. Okay, so what was the one Chinese stock that Bridgewater actually bought more of? The answer is none other than Baidu, one of the largest internet and AI companies in the entire world. This Beijing-based stock is looking up, and Bridgewater bought 120,000 more shares, bringing its total up to roughly 1,140,000 shares. But we haven't still explained why they bought it. Well, there are a few things going for Baidu that may excite an investor. For one, the company's AI cloud may not rank top 3 in the nation, but it's growing at an impressive rate. In the second quarter, its revenue increased 31% year over year. The next biggest increase was Alibaba, which posted a measly 10% gain. Baidu has also been in talks to sell its stake in the video streaming company Iqi. I tried my best with that. I don't know if that's how you pronounce it, but we're going with it. And Iqi has been struggling for some time, and this would take a load off of the company's bottom line, as well as put some nice cash in the bank for them. Assuming Baidu makes it through these Chinese regulations and US audits, you may see it rebound stronger than most Chinese stocks with these green flags to encourage investors. Do your own due diligence and research whether this stock is right for you. Ray Dalio and his team seem to think it's a pretty good idea. But that's all we have in store for today's video, ladies and gentlemen. We appreciate you checking out our content, and we'd love if you could like and subscribe to keep us going, and comment if you think Ray Dalio and company are smart for investing in Baidu. And until the next video, I'll be seeing ya.